In this video, I'll be showing you how to create your own watch list so that you are not restricted to the watch list I have shared with you on my website. So as you know that being a techie, I overwhelmingly am interested in trading tech stocks, and my watch list mainly consists of tech stocks. It does contain a few indexes and ETFs, but still, mostly revolves around tech stocks. Now, why would you want to have your own watch list? So, if you read my book, I have mentioned in my book that you should have a really small list, a small universe of stocks that you trade. And in addition to that, and the reason for having a small universe of stocks is that you want to be fully aware of each stock's price movement at all times. And that just cannot happen if you have 100 or 200 stocks in your watch list. So my watch list doesn't contain more than 10 stocks. Sometimes it can go up to 15, 20, but usually I'm monitoring 10 stocks at a time. And the reason for that is on a daily basis, I might be reading news about those stocks or just watching the price movement. And when a stock goes too far from its mean, so either it goes up too much or down too much, I intuitively know that I need to start looking at some kind of a trade for this stock. So that's the reason for having a watch list of stocks that you can follow, and you are just connected with those stocks so much that you intuitively become aware of any unusual movement in those stocks. So another reason for having your own watch list is these days we have this coronavirus scare going on in the market. You may want to maybe start trading health stocks, or you may start wanting to trade insurance stocks. So depending on the market conditions, you may have 4 or 5 watch lists. So let's say suddenly the auto industry is booming, you may want to switch to your auto industry list. So it's always good to have um, 4 or 5 watch lists if you can, and then based on the market conditions, you use the watch list for the industry which is currently booming. So that's always a good idea. How do we select stocks to trade? So it's not a complicated process, but there are two main things which you need to be aware of. And strangely enough, people don't pay attention to these things. So people, what they'll do is they'll go to Facebook group or some kind of online forum, and they'll start asking people about stock tips. They'll start asking them which stock should I buy. That's a really bad idea. You should be able to find the stock that you want to trade yourself. Towards the end of this presentation, I'll show you a demo of how Think or Swim can do that for you. So it's going back to the stock selection criteria. There are two things. One is price, and price is a more important factor for the 25K challenge because of the unique nature of the challenge, which I'll come to in a second. And the second factor is liquidity, which I'll spend enough time explaining you why liquidity is important. But liquidity has 3 components. One is volume, and volume means the volume of the stock and the volume of its options that you're trading. Second is open interest, and then finally the bid and ask spread. So let's talk about the price. So why did I mention price in the selection criteria? So for the 25K challenge, we start out with a really small amount of $2,500. So the kind of trades we can put on are very limited. Like a lot of people ask me, why don't you do credit spreads? You can do credit spreads, but the problem is, from my experience, you need an account of at least $15,000 to $20,000 to use credit spreads effectively. Since we have such a small amount in our account, which is $2,500, the only thing that has that really works for us is doing debit spreads. So, and with $2,500, you will notice that my initially when I start out, my each of my trade is risking $250 per trade. I can go up to 500, but I prefer 250 if possible. So, what can you get for $250? So you'll notice that the debit spreads, the math is really simple. A $5 wide add the money debit spread will usually cost you half of the width of the strikes, which is if it's $5 wide, it'll be 2.5, and since options have a multiplier of 100, it'll be 250. If it's a $10 wide spread, it will cost you $500. So when you're putting on the trade and you're risking $250, the goal of the trade is that the stock should move at least $5 in the next 30 days. So because we have that requirement of the stock should move at least $5 in 30 days, that is the reason why we cannot trade lower priced equities. So if you take a stock which is trading at $2, what are the odds of that stock going from 2 to 7 in next 30 days? It's virtually impossible for that to happen because the reason is from $2 to $4 is a 100% move in that stock. We are talking from 2 to 7. So it's like more than 200%. Yeah, it's a huge move. So stocks at that price, they just don't move that much. So because of that reason, we cannot trade lower price stocks.
The second criteria is that we need to avoid low volatility stocks. What does that mean? Volatility is generally described as how wild a stock's movement is away from its mean. So, for example, if you take the stock BKNG, Booking Holdings, formerly known as Priceline, the stock can move $100 to $150 in one day. So it's a highly volatile stock. Uh, on the other hand, a low volatile stock, a great example of that is Microsoft. So right now, Microsoft is a good stock to trade. So this doesn't apply today, but you may have heard of this term called the lost decade. So when Steve Ballmer was the president of Microsoft, uh, the stock was literally stuck at $30, approximately in that range, for 10 years. The stock just did not move. That's an example of a low volatility stock. Since we need some movement in our stock, the stock that we are trading, we need to avoid stocks with low volatility. So avoid low price stocks, avoid low volatility stocks. And finally, usually any stock which is priced between 100 and above works out pretty decent for my criteria. The next criteria we need to talk about is liquidity. It's, in my opinion, it's the most important factor in stock selection, and not many people pay attention to it. So liquidity is defined as the ability of getting in and out of a position with ease. This is especially important with high volatility in the market. To explain liquidity, let me use a real life scenario. So let's pretend that you have this antique car sitting in your garage and you want to sell it to generate some cash. Now, you have two options to sell it. The first option is that you find someone either in your friend circle or somebody you know who is an antique collector and wants to buy that particular model. This is the ideal scenario because uh, this is an antique car, so the demand for that car in the market today might not be that much. So there is a very small range of individuals who might be interested in that. But if you do happen to find that person, that's great because let's say you want to sell the car for $10,000. That person is interested in that particular model, so they'll just say, They'll just give you that money without any price haggling and negotiations, and you make your money. And plus, another benefit of this kind of scenario is there is no middleman. So, whatever money the buyer gives you, you get to keep that money. So, that's the ideal scenario. That doesn't happen a lot. What's the other option that we have? So, if you want to generate some cash by selling this car today and you don't have any buyer available, you have another option. And that option is called going to the market maker. In this case, the market maker will be a car dealership. So you may go to the car dealership and tell the guy who runs the dealership that I want to sell this car to you and I want $10,000. So the car dealer at this point will do many things to come up with a price that he wants to pay you. So you want to sell for $10,000. The car dealer will have to go to his database and check a couple of things. So one thing he would want to check is how many people are even interested in buying that model. Now, if you think of the car dealer, he is a connector. So he is connecting potential buyers to potential sellers. So he may go back to his database and check in the last 1 month, I had 5 parties interested in buying an antique car like this. So he knows there are 5 interested parties. Now let's call the interested parties as the open interest. And I will relate that to our trading platform. So he sees that he has 5 people who are interested. That's good. There's some interest in your unique car model. And then the other thing you might want to check is the volume. So in the last 1 month, how many models like that has he sold? So based on these two parameters, he'll quote you a price. So you wanted 10,000, he may come back to you and say, I'll offer you $7,500 for this. And there could be many reasons why he offered you a lower price. He may know in his mind that he can turn around and sell that car for $12,000. But the thing is, maybe the open interest in that car is very low. So there may be only 2 people interested in that kind of a car. And so now, if he buys that car from you, he is running a huge risk of not being able to sell that car. So if he calls those 2 guys who were in that open interest list, who were interested in that model, and they refuse to buy it, he may be stuck with that car. And that car might be sitting in his dealership for a year. So his money is being tied up now. So what he needs to do is he needs to make a sensible decision where he gets the car from you, he takes on the risk of the car sitting in his dealership, but he gets paid for taking on that risk. So that is where the concept of bid and ask spread is comes in. So your asking price is $10,000. He may come and give you a bid of 7,500, and the difference between that bid and ask spread is the amount that he wants to get paid for taking on that risk of buying that unique model which doesn't have much volume and doesn't have much open interest. So in the stock market, the same thing happens. When you buy stocks which are not which don't have high volume, which don't have high open interest, then you will notice that they have wide bid and ask spreads. And what we want to do is, when we are doing our stock selection, is we want to avoid buying these stocks, because when you buy a stock which has high volume and high open interest, the bid and ask spread is automatically low. let me finish this again with the car dealership example that I gave you. So instead of selling this antique car, if you had a Tesla, which is in high demand right now, so if you went to the dealership and you told the guy that I want to sell this car for $50,000, he might buy it for 50,000, or he might even buy it for 49,500, because when he goes to his database he can see that there are like thousands and thousands of people interested in that model. Plus, if he checks the volume, he can see that there are many Tesla cars that he has sold in the last month. So high volume and high open interest, that means he literally has no risk of that Tesla sitting in his dealership for any amount of time. So in that case, what he will do is he doesn't want to make money from the bid and ask spread, because there is hardly any risk of that car sitting in his garage and tying up his money. In this case, he's actually making money by volume. So he may be selling 500 Teslas in a month, and although he's making pennies for each sale with the bid and ask spread, he's making his profit from the volume. So the same concept applies with the market makers in trading. So if you choose a stock which has high volume and high open interest, then you are more likely to not pay a big differential between the bid and ask spread. So the liquidity parameters that I use for my trading methodology are as follows. So for volume, I look for stocks which trade at least a million or more shares every day. Then, since we are option traders, we also need to pay attention to the volume on the options. So for that, I typically look for at the money options having a volume of 500 or more. So that's the volume. Then what I also pay attention to is the open interest on the options. So I look for a value of usually 1,000 or more. And what you'll notice is that the volume and open interest kind of go hand in hand. So if you find a stock which has the at the money options have 500 or more in volume, most of the time automatically the open interest criteria will fit for you, and it's vice versa. So if you find an option with open interest 1000, most likely the volume of the at the money options will also be 500 or more. So once these two criteria are in place, automatically the bid and ask spread will be tighter for all the stocks and options that you find. So we are in Think or Swim right now, and you will notice that Think or Swim has a tab called Scan. That's where we find stocks that we want to trade. So click on Scan, and there are options here: stock hacker, option hacker, spread hacker, all this stuff. Let's just focus on stock hacker for now. So what it has already done for you is it has chosen three parameters for you already. And let's start from the top. So it says none of them have any values filled in. So let's say the stock, this is the parameter, and there are many things you can filter the stocks for. So ask price, bid price, volume, shares, put call ratio. There are hundreds of things you can choose here. I mean, not hundreds, but plenty, quite a few. So the first criteria, if you remember, that I have is I want to trade stocks which have at least a volume of more than a million shares per day. So let's find volume, and there it is, volume. And then it's telling you it already found 11,000 matches for that. Let's say the minimum volume is 1 million. Okay. 1 million. So as soon as you tab out, it automatically applied that. It's showing you that this was the universe of stocks it was looking at, and you are just wanting to restrict it to this range. So it from, I don't know, it was 7,000, 11,000 stocks. Now it's gone down to 2,200 matches. So we put that filter in stock volume. So the second was the volume in the options, right? So since these two say stock, let's just delete these two criteria and start from scratch. So I'm going to exit out X, and then I'll add another filter here, add filter, and I'll say option. So now option will come with its own parameters or filters that you can choose. Let's choose volume for options as well. So volume. And what was the criteria for volume for the options? It was 500. Filter that. It narrowed down the list here. Now let's add another filter, option, and let's say find open interest. Open interest. There you go. Minimum open interest we need is 1,000. So I added all these options. Now I click scan. So it's going to go out to its universe of stocks, and it will spit out stocks that fit into that criteria that you have specified. Now one thing you will notice is, not many people realize that this, when you say the volume of the stock should be at least 1 million, what that means is when you're searching for stocks right now, the volume of the stock should be 1 million. So let's say the market opens at whatever time, I'm in mountain time, so 7:30 the market opens, and if you're running the scan at 7:45, the volume hasn't picked up for that day. So you are putting in 1 million restriction here. Maybe the volume of Apple is only 500,000 in first 15 minutes of opening. So you may miss out on the stocks which actually have that volume, but it hasn't, since it's so early in the day, it hasn't gone up to that the actual volume. So what you need to do is you need to use something else. So let's click on this add filter, and there's this option called study. Let's add that, and you will see study really means actually technical indicators. This is like really powerful feature that's built into Thinkorswim. So what you can do is, in my case, let me go to volume, this study, and there is something called average volume here. Now what does that mean? So what that means is I'm using, instead of volume right now, I'm saying if the average daily volume of the stock in the last 50 days, 50 period, right, is more than a million. That's what I want. So 1, 2, 3, 4, 5, 6. That's a million, right? Let me remove this original volume filter here. So what it says is, if your average volume in the last 50 days is more than a million, show me those stocks. So once you do that and you click scan, then it will bring up the right stocks. Okay. So as you can see, there are like tons of stock that are popping up in this list. So so now you can decide based on the stocks that are showing up if they match the criteria that we need. Now before we move on, I want to show you one more really cool thing about Thinkorswim. It has something called pre-built watch lists. So if you remember, on this side we have this watch list widget here. So you can, right now it's set to my favorites. You can click this open, and you will notice tons of options here. So for example, if you can go to top 10, you can just choose these watch lists. For example, if I want to choose top 10 losers in NASDAQ today. I'm going to choose that. It should. These are the top 10 losers in NASDAQ today. So similarly, it has top 10 gainers in NASDAQ, top 10 NYSE, so top 10 sizzling stop, top 10 volatility increase. So there are all these pre-built watch lists for you. And I recommend that you play around with this because this is like really powerful, and I think you should spend some time on this and take advantage of it. So for Tastyworks users, I know that I recommended the platform to you because it's a really intuitive platform for beginners. But if you could sign up for a for a Think or Swim or a Meritrade account, and you can leave the account empty, you don't have to put money on it. So you can just get access to the paper trading software. That will be awesome because this software is really mind blowing. So anyway, so there's this thing called top 10, then lovers and losers, pre-market movers, analyst downgrades, analyst upgrades. You can just choose these lists and it will just pop up automatically. Then they have these public lists sorted alphabetically. So let's say all ETFs, double long ETFs, economic indicators, futures, and then let me go to this one. So Russell 3000 stocks, S&P 500 stocks, schedule earnings in the next 5 days if you want to, if you are into earnings trades. I mean, just take your time and go through this. I mean, this is a lot of stuff here. So one thing I want to bring your attention to is at the beginning of this I mentioned that it I recommend if you can have 5 or 6 different types of watch lists for different industries. So what you can do is once you have your parameters here set, you can go you notice that there is an option called by industry. So they have energy, materials, industrials, consumer discretionary, financials, all this stuff, real estate, all this stuff here. So let's say you are in the process of creating a watch list. So what you do is at the top where it says scan in all symbols, you open that and the same menu that you saw in the watch list widget will show up. You go to by industry and let's say you want to create a watch list for real estate. So go to real estate, select all real estate, and now what it's going to do is it will apply your criteria to the stocks only in the real estate industry. So you can just click scan and it will only bring up stocks in the real estate industry that are liquid, with have high open interest, with tight bid and ask spreads. And then what you can do is you can right click on this and say add this stock to a watch list. You can create your own watch list and just add it to that watch list. So for example, you could go to say create watch list here and call it real estate stocks. Once you have that watch list created and you're doing your scan, just right click here, select the stock and say add to the watch list. It will start showing up here your new watch list. So you could do real estate, you can choose the industry. You can just make your watch list for let's say IT, my favorite, right? So IT, there you go. All the stocks that I have will most likely be here. You have the Microsoft, you have Apple, Nvidia. These are the stocks I like to trade, but I'm actually missing a lot of stocks in my list. I'm not doing Dell. Dell is a great company. So you could play around with this and come up with your own watch list. Another cool thing is, so what you're doing right now is you're creating watch lists specific to an industry. You could also do this. What I'm trying to find out for you is here. If you go to public and say S&P 500. So as you know, S&P 500 is an index which represents the entire economy of the United States. So S&P 500 is a bucket of every single industry. So it's like a master bucket. So if you choose S&P 500 and run this scan there, it will bring up stocks from all over the industry. It could bring stocks from financial, it could bring stocks from information technology. So if you want to have a watch list which represents the broader market, so you want to spread out your risk by not trading only technology stocks or only real estate stocks, you could just choose S&P 500 and it'll give you a nice list. And if you look at this these columns here, you can customize this. So let's say I'm going to click on customize, and I don't want paid, ask, high, low, vol. Let's remove these. You can add industry, right? And let's go net change. Click OK. So now what it's showing you is all these stocks in S&P 500, and it shows you which industry they belong. Airlines, biotech. So if you want to create a nice balanced watch list which represents the entire stock market, the broader stock market, you can use this for that. So that's how you use Stock Hacker. This is Stock Hacker has many more advanced features. You can even write your own script and put in your own criteria. But I'm not going to go into that. But the goal of this video was just to show you how to create a watch list, um, what criteria you should consider for having your own watch list, and how to use Think or Swim to help you do that.